What's up, owner investor? In this video, we are going to figure out how Spotify makes money. So same drill as the previous one. Crack open the Spotify model that you should have had from the previous modules. Let me open mine up here. So mine is blank once again, but this doesn't really matter. We can come back to this later. So create a new tab and then do exactly what we did for Airbnb and for Spotify. So you'll have to make some decisions on how you're going to break up the business, right? So the PDF is also on this video page. It should be called Spotify case docs _2. So you have to make some calls on like decisions on how you want to break up this business, what makes sense to you in terms of, remember, like driving, like what are the key drivers of this business? Like how does a business make money? I'll give you a clue, right? So there's two segments to this business. There's one segment where people pay a subscription and another segment where they generate ads, right? And that's broken up for you. And the MAUs, that stands for monthly active users, right? So just another one of these technical terms in the industry. Just think of it as like the same thing as subscribers. It's just users. So all the units are in here. Yeah. So cool. I'll see you in 10 to 15 minutes. And I've also included the balance sheet. I know there's like a lot of line items here. The only two things that you need to look at here is the exchangeable notes, which is the same thing as it's just debt. It's money that they've borrowed. Um, and then I don't see any current portion of debt. Don't worry, like we'll talk a little bit more about current liabilities and current assets, which kind of feeds into this concept of working capital. I'm saving that for the growth module because that's kind of one way to think about like dollars that need to be reinvested into the business and how much of those dollars that are reinvested is funded by your vendors and your customers versus the business itself. So again, like I'm sorry if there's just a ton of numbers in here. I also just want you to again get used to the idea that you will be presented with more information than what's necessary. So you need to kind of pick out what matters. And I tend to get overwhelmed with numbers as well, which is why I keep my Excels nice and clean, basically out of necessity. So if that's kind of a pain point for you, I totally get it. But that's just kind of the reality of picking your own stocks is there are just a lot of numbers. And the key ones to focus on here are the exchangeable notes, right, 1.2 billion euros, and then the short-term investments and then the cash, right? So again, Spotify is a net cash company, right? So they have more cash than debt. So, all right, I'll see you in 10 to 15 minutes. All right, now that you have constructed your simple model, let's go through this. So the years are 2020, 2021, 2022. Okay, so I'm going to break this up into premium, subscribers, times revenue per subscriber. Premium revenue, gross margin, premium gross profit. And like in terms of the formatting, this doesn't matter. It's like whatever, like a silly aesthetic thing. I format my stuff this way because it's kind of just the way that I'm used to seeing things. This is the formatting I used in my old job. So whatever like formatting you like to use, just make sure you differentiate between stuff that's like punched in, like a number that you type in versus like a formula, because you want to differentiate between numbers that are in the future going to be drivers that you should can change that you can play with versus numbers that you shouldn't mess with because they're calculated. Um, if that doesn't make sense, just post something in the comment section and I can clarify that a little bit more. So delete sheet. Is this rows? Sorry, I need to make my face a little smaller. Delete rows. Okay. Delete table column. Ooh, delete sheet columns. Okay. So premium subscribers, we have 155, 180, 205. Premium revenue, we have 7135, 7135, 8460, 10251. So just for like a little bit of context here, when you're just kind of typing in these numbers, so it's not so mindless, so that you're still kind of like, like the brain is still going while you're doing all this kind of this menial task of typing in numbers into Excel. You can see this revenue per subscriber number, and if you are a Spotify member or you have Apple Music or something, you can kind of start to think about like, oh, that's because that number is part of your daily life if you're a subscriber to anything, right? But remember, this is an annual number, right? So if you pay, $10 a month, that means you pay $120 per year, right? So you can start thinking about like, okay, $50 a year, is that, remember Spotify doesn't just operate in one country. I think they're in like over 180 countries where different people have different kind of income, so they can't just charge the same price everywhere because not everyone can afford the same price that Americans and Europeans can pay. So you can start kind of thinking about like, is that a low number? Is that a high number? Does that have room to grow? So yeah, so this is the premium revenue, and then premium gross profit, cost of revenue. Okay, so I think they actually do give you gross profit for each one, right? Okay, we'll just subtract out the cost of revenue. So 5126, so equals this minus 5126, right? Because this is the cost of revenue, and we want to calculate margin percentage, because generally we're just going to treat this as a variable cost. If later on we want to tweak this a little bit more, we can, but for now we'll just keep it nice and simple. So 5986 equals this minus 5986 equals this minus 7355. Okay, so 28% margin. It's like not ideal, right? So let's see. So you notice here that they mentioned this thing, right? Royalty costs. So that's kind of the biggest component to the cost of revenue for Spotify, right? I just switched here, so I'm looking at you instead of to the side. And that's a big reason why this margin number is so depressed, right? Because the record labels take a pretty big chunk of the economics of the business. And this is a big reason why people either hate Spotify or people love Spotify, right? The people that hate Spotify say the company's never going to make any money because they have to pay all this money out to the record labels. But then the people that love Spotify say, well, but long-term Spotify will capture more and more of the economics as their agreements reset and Spotify has more and more power in the music streaming ecosystem. They'll be able to demand better terms with the royalty vendors, right? So this is kind of like one of the debates that happens between people that are bullish or positive on Spotify and people that are bearish or negative on Spotify, right? And this kind of gets to this idea of there's kind of no right answers when it comes to investment research. It's just degrees of reasonableness. Yeah, it's a term I just invented. Um, there's always debates, going back and forth, and so it's not like math class where there's a right answer. Um, it really depends on, you do your research. It's very subjective, is what I'm trying to get at. And that's one of the most challenging things about investing. Like a lot of people with like really high IQs that are brilliant, like just cannot handle this aspect of like there's no one right answer that you can check, in the against the answer key, because that's just the reality of it, right? Like we live in a world that's probabilistic and not deterministic, right? So you kind of have to figure out what all the different ranges of outcomes are, and then see like in the best case, how much money do I make? In the worst case, how much money can I lose? And then you're like, okay, generally what's the likelihood, the probabilities of those, and then overall, like what's the risk reward, right? That's kind of the exercise that we're doing throughout the course. But this is kind of like one of those components, right, which is gross margin percentage, which is really low. And it's like in 10 years, is that going to, stay at 28 to 30%, or is that going to be like 40%, or is that going to be like 60%, or is that like 80%, right? And that's where your research comes in, and that's where it's helpful to leverage other people's work. That's where it's helpful to kind of see different metrics like, the number of maybe artists that Spotify is signing, and like the scale of Spotify, who has more negotiating leverage? Is it the record labels or is it Spotify? Who needs the other party more, right? And it's kind of like thinking through those things. So I just kind of like my goal for this, like when I'm going through this exercise, and I know I'm already at like 12 minutes here and we're only 10 lines in. I just want you to kind of, as much as I possibly can, I want to show you like when I'm doing this exercise of like typing in numbers, what's like going through my mind, right? Like what are my eyes and what's my mind perceiving when I'm doing this exercise? And hopefully through like hearing this, you can start kind of cultivating that pattern recognition, those mental models that you need to do this on your own, right? So if, as we're going through these exercises, if like, if it feels like you're just making mistakes, like, you thought something was in thousands and it was in millions, and you're just like getting frustrated that like you're not getting the right answer, that's not the point of this, right? The point of this is not, like I've purposely picked these companies because there's curveballs in them. And so this is meant to be like, you're probably not going to have like the same setup as I do, and you're probably going to miss like a few things. Like I designed it on purpose so that you can learn kind of like new perspectives and new angles to do this, right? Because again, like the goal is for you to be able to do this on your own. And there's just so many corner cases and so many, like I didn't include a company that's like that does a lot of acquisitions, for example, right? So that's like a whole nother corner case, and maybe we can do another like more videos on that. But or like companies that are in distress, right? Um, like there's just a lot of corner cases. Like I'm not going to be able to um, show you examples that fits like everything. It's just like the only way to solve for this is just to get more and more reps. And getting reps, it's like just like going to the gym. Like it's painful initially, but as you get better at it, it'll start coming like easier, and then you'll be able to like very quickly. And that's like the fun part, right? Like when you kind of see yourself develop, right? So this is like whatever, like a 5-minute motivational plug. But I know this stuff can be really boring just typing in numbers. So I just want to kind of keep like the bigger picture in mind as we're doing this, because I used to hate doing stuff like this in Excel, just like typing in numbers. But like when I'm constantly like thinking about the story and like the bigger picture and like what role is this like specific task playing in the bigger picture, it helps me a lot, right? So anyway, we onward we go. So this is the premium segment. I'm just gonna have a little header here. Insert rows. Premium. Okay, and then add supported. Add supported revenue, gross margin, and then supported gross profit. Okay. So add supported users. Go back up here. So we have here the MAUs 199, 236, 295. 199, 236, 295. Color this blue, it's hard coded. Reduce the number of decimals. Okay, add supported revenue, 745. And just one note, like these are all in euros. It's just something to keep in the back of our mind. If the share price is in dollars, this is in euros. We'll have to do a little foreign exchange conversion later on. Okay. So this number is a common industry metric, which is called ARPU, average revenue per user. If you look at like Facebook or Twitter or Snapchat, this is like a really important metric that you can now compare, right? Like how well is Spotify monetizing its users, right? So in these ad businesses, like in social media, right? We the users, we're the product that's being served up, right? um, to the advertisers. The real customer is the advertiser. It's not us. But in the premium business, the customer is consumers. It's people like you and me. Okay, cost of revenue, ad supported is 739. So this minus 739, ouch. 6 million euros in profit, that's kind of rough. 1091 equals this, minus 1091, it's much better. Yeah, nice little increase there. 1446. Whoops, came right back down. Okay. So this is probably like one of the worst gross margins I've ever seen in my entire life. But again, you can view that in two different perspectives, right? You can either say, wow, this business sucks. Or you can say, wow, this business has a lot of room to improve that, right? Okay, consolidated. All right. What do we have here? Research and development, sales and marketing, and general administrative. Okay, so in this example, because they kind of break it out in this way, I know with Airbnb we lumped everything together because I just wanted to kind of introduce the concept. I'm actually going to break all these different things out. So I'm just going to call this R&D, right? So this is like a bunch of programmers. It's like that's basically just labor costs of hiring a bunch of programmers to come in and like code and add different features to the app. Um, testing out different things. Maybe like trying out new product segments. All sorts of different things in there that's being lumped in as R&D. Most companies kind of like the way that most businesses work is that at the beginning of every year, there's a budget that's set for the rest of the year, right? And the way that a lot of most companies set their budgets at the beginning of the year is they say, okay, like make a forecast for how much revenue we think we're going to do, and we'll allocate like 10% of forecasted revenues for this year for R&D, right? And so as the business grows, they're like, well, we can actually invest more and more in R&D. So that might increase as a percentage of revenue, right? So it goes back and forth. There's no like clear answer that always applies. Whether you want to forecast operating expenses as percentage of revenue or like as a percentage of revenue or as a margin, right? Same thing. Or as just like a fixed cost that you increase at a certain percentage, right? Like if we were looking at it like a steel mill or something that's not really reinvesting in the business, right? We would treat the operating costs as generally like a fixed expense that's, probably declining because they're taking out different like costs out of the equation to kind of improve the margins because it's a mature business and you want to cash cow the business, right? You want to pull out as much cash as possible from it versus a growth business like Spotify. The team is probably reinvesting aggressively back into the business for future growth, adding new features, competing with Apple Music, right? So it's a judgment call that you'll have to make. And I know like I'm not like kind of in most like I guess like online courses maybe they'll give you like exactly what to implement and it's like very concrete and fixed and you like take this concept and you apply it in like a very like linear way. And what I'm doing here is just kind of giving you like little tidbits so that you can kind of just remember that you like heard this like anecdote here, like this concept here. Oh, maybe I should like it'll just help you when you look at like, in the future, if you are looking at like a declining business, you might maybe remember what I just said. And you'll be able to remember like, oh, okay, maybe I should think about the operating costs as a fixed thing versus a variable thing, right? So it's not like the most linear way of teaching, but it's just there's just so much information that maybe in version 2.0 of this course I can like break things up into like even more kind of like a systematic way. But like one of the things about investing is that you know it's important to have frameworks, but it's also important to be like to be like a free thinker and to think from first principles and be able to like build up your thinking specifically for each situation, right? Like you don't want to get stuck in these like formulas where you're just like doing like these cookie cutter things because that's how you get in trouble, right? Because every company, every like even the same like industry, two competitors in the same industry, sometimes their disclosures might be different, right? Some of them might include some things in cost of revenue, and the other competitor includes that same thing instead of in cost of revenue in like general administrative or like in somewhere else, right? Like a lot of retailers, for example, include their rent in cost of revenue instead of like operating costs, right? So I just want to kind of emphasize that you have to look at each company in a different way. And the annual report is basically like an instruction manual on how to like think about the business. That's in a way, that's what it is, right? It is also telling you what happened with the business, but it's also telling you like, hey, this is how the business works. And companies they don't just come out and like tell you the most simple, straightforward way to think about the business. They kind of they hide the ball a little bit, right? Sometimes for competitive reasons, other times just because like their internal controls suck, right? So if you ever come across a company where the numbers are just like a complete shit show and the annual report is like 300 pages long or something, and there's like all these footnotes, just pass on that one, right? That's the beauty of investing is like there's no called strikes like there are in baseball, right? You can just pass and you can wait. You can find a company that's like easy to analyze. There's like tens of thousands of publicly traded companies in the world. You don't have to like pick. You don't have to pick one. You have a lot of choices, and the prices that securities trade at today are not the prices that they'll trade at tomorrow or like next month or in 6 months, right? So it's better to kind of be opportunistic and be patient and wait until you get that great opportunity, that fat pitch, and you swing at it, right? So this is another super long video. I apologize, 24 minutes, but I think this stuff is useful. If it's not and you want me to kind of make these shorter, tell me in the comments and I'll shut the fuck up. Okay, so minus 837, minus 912, and minus 1387, minus 1387. Okay, I want the percentage to be a positive number, so I'm just going to throw a little negative on this. Just another nitpicky thing. You can go either way. All right, 11%. And we will italicize that. Okay, R&D. Okay, so this is where it gets a little bit tricky, right? The sales and marketing. Because the context for this number, this is like, if you ever, it's just I'm throwing a lot of Shark Tank references on here because A, I love that show, and B, I think like a lot of the stuff from that show is relatable to a lot of people, and um, yeah, like it's relevant here, right? So Mr. Wonderful, right? Kevin O'Leary, he loves asking that question, what's your customer acquisition cost? Um, and that's basically what this is, right? So the context for this sales and marketing number is not all of it is advertising, right? So it's again, we're making a simplifying assumption, um, and we're kind of including a lot of other costs, like like labor costs, like people that work in the marketing department, their like salaries and their benefits are going to be like lumped into this number. But we are going to break this up into new users that they've added and the implied customer acquisition cost per new user that they've added, right? Um, so there's like a bunch of simplifications that I'm making here. So people with a marketing background might freak out at me because they're used to seeing these numbers in like way more detail, like broken out into like gross churn, net churn, retention curves, like broken it up by geography. But as public investors, we only get like a limited amount of information, so we have to make simplifying assumptions. Um, so we are going to break this up into net new users, right? Because when you really think about this, the growth in subscribers and in ad-supported users, um, what's really happening there is that every month or every quarter or every year, um, there are subscribers that are leaving Spotify, and then there's new folks that are coming in, right? So there's a churn number, and then there's like gross ads, but that's not broken out like consistently by Spotify. So we're just gonna have to do like a net number which collapses those two, the churn and the gross ads, right? So again, it's a simplifying assumption, but unfortunately that's kind of what we have to work with as public equity investors, right? Like you're like we're playing this game with blindfolds on, but the good news is everyone in the public markets is playing with blindfolds on, right? So it's about like who can make more reasonable and accurate assumption with limited imperfect information. That's the game we're playing here. Is you have to get used to this idea of imperfect information. And again, like it's not like we're putting our entire net worth in one stock, right? So that's why you diversify, because you just have imperfect information. There's like things that can go wrong. Like we can be wrong in our analysis. There could be like some kind of disclosure in here that if they provided, like our view on the company would completely change, right? There's all sorts of stuff that make this challenging, but also fun. So 1,000, okay, so net new users, we're only going to be able to calculate this for 2 out of the 3 years. So premium subscribers plus ad supported, because again, like it's not like Spotify breaks up the ad budget for us into what goes into acquiring premium subs and ad supported users. They just spend marketing dollars, and then over time, like premium subscribers and ad supported users come in, right? Sorry, there should be a plus. So I'm just adding up like the two subscriber / user counts in 1 year and subtracting it from the previous year. So we'll know like how much subs that they've added, right? Both paid and unpaid. We're just going to call this CAC, customer acquisition cost. I don't know, I'm just going to type this up. I don't want you to have to like memorize new terms, so I like to just kind of keep things in as much plain English as I possibly can. I'll change this to research and development. I think it's one of the pain points I know with like learning investing is just getting lost in definitions, and people love throwing around jargon to make other people feel stupid, and like I think it's just silly, and the goal should be able to explain this to a 5th grader. So okay, so sales and marketing minus 1029 minus 1135 minus 1572. This is a number, reduce the decimals. This is a calculated number, so we're going to keep that black. Okay, so Spotify spends an average of $18 to acquire a customer. So if Daniel Ek was pitching Spotify on Shark Tank and Mr. Wonderful asks the question, what are your customer acquisition costs? 18, $19. Okay, that's sales and marketing. General and administrative. Did I spell that correctly? Okay, why don't we just call this admin? Okay, and then I'm going to make this another percentage of revenue number minus 442 minus 450 minus 626. Make that blue, reduce the decimals. And we're adding these two revenue numbers. So what's this? Okay, cool. So this is going to be really important when we forecast growth, because a big portion of the growth is like what's Spotify's customer acquisition costs, right? Because growth isn't free. Like it comes at a cost, right? So breaking up the unit economics like this, we can figure out what it's going to cost. Because like a lot of people, when they get to this kind of step in their development as an investor, where you break up the unit economics, and you're like, okay, well, Spotify has, whoa, oh, it's control. Okay, what? All right, Spotify has 500 million users, right? And, I think like 90% of the world's population listens to music. I think half the world's population has internet access at like 4 billion people. So like that number has a lot of room to grow. And so someone might say, okay, well, like I think Spotify can get to like, 2 billion users, and I think ARPU can get to this number, and I think like margins will be this, and I think this is what the earnings will be. But then it's like, okay, but what is it going to cost to get there, right? And that's why it's important to break it up like this to the customer and break up the customer acquisition cost. Like another view that you might have is that the customer acquisition, like the churn used to be really high, and then maybe it'll get lower, and so maybe the customer acquisition cost will actually come down over time, right? Like if you look at a lot of these internet businesses like Amazon, their customer acquisition costs would start off like really high, but then as they build trust with customers and like unaided awareness of the product grew, the customer acquisition costs kind of went like this, right? Like it came down over time, right? So those are all kind of things to just like keep in the back of our mind as we're going through this. So now we can get to operating income. Operating profit, whatever you want, doesn't matter. Same fucking thing. Plus this, right? So this is obviously a very different picture from Spotify because, oh, whoops, I did not include this. There we go. Because Spotify is losing money. All right. Again, this is like another key thing is to just like check numbers to make sure that you like typed stuff in correctly, right? It takes practice to do this, and fingers crossed that I didn't fuck something up here. Okay, so minus 293, yep, correct. Nice. 94, yep. Negative 659, nailed it. Okay, so that's the operating income. What I was going to say is it's obviously a very different picture from Costco, which is like a nice, steady, profitable, more mature business than Spotify, which it looks like it's losing a bunch of money, but that's not necessarily because Spotify is in like distress. It's not like I don't want you to look at this negative $660 million of operating profit and be like they're going out of business, right? It's because they're reinvesting in the business, right? And remember, um, like they have like a lot of cash on the balance sheet, right? They have like $2 billion of cash, 2.7 billion, minus like yeah, it's even more actually, right? Because it's the 2.7 plus the 756 of short-term profits. It's like whatever, call it like 3.5 billion euros minus like 1.2 billion of debt. So they have 2.3 billion of net cash, and so they can absorb these losses, right? Like they've raised extra money in the capital markets to grow, right? I mean, it's the same thing that with like people, right? Like when kids go to college, if their parents have to pay for it or if they have to take out loans, if students had to file like their own financial statements, like their income statement, it would look like garbage, right? It would look something like this. Maybe the numbers, would be smaller. The scale would be, probably unscaled instead of in millions of euros. But that's not necessarily a bad thing, is what I'm trying to get at. And like, um, what really matters is like, okay, is the business does the like, but should the business exist? What problem are they solving for customers? Is it a defensible business? What are the economics today? What are the economics going to get to? Like, how are the economics going to change? But again, like if it's a riskier strategy, right? To look at companies like this where they're losing money today, right? It's generally, I'll kind of limit these types of names to a lower position size, all else equal, because there's uncertainty on whether they'll be able to get there, right? Like, unless you think the management team is phenomenal and maybe you have a view that they will absolutely get there, and then you can kind of be more confident in the name. But also, like, you know, I don't want to do this in this video because it will take way too long. But this is kind of like a wild fluctuation in the operating income, right? So kind of want to get to the bottom of that at some point, and think about like what's causing that wild change. Is again, like, is this a short-term issue or a long-term issue, right? Um, and that's one of the most difficult parts about investing. Again, is trying to figure that out. And again, it comes with practice. So because they're net cash, like I don't really want to model like the interest income and like the FX and like all that nonsense. So I'm just gonna keep this simple, 25% tax rate. Um, Again, like this is not always the case where I'm gonna ignore this, right? Like Basic Fit is gonna be an example where they do have debt and there is like a pretty significant interest expense that comes in every year from paying interest on the debt. And so I'm not gonna like skip over that for Basic Fit. Just as a clue to the next video. Okay, so now this gets a little bit tricky because when companies have um, negative like pre-tax income, they get tax credits, and I mean yeah, like that's another like advanced section that we can do later on. This is kind of one of the downfalls of doing like real world examples is like obviously the real world is really complex and like I don't want to throw too much complexity at you at once. But the reality of how this works is that there's tax loss carry forwards. Um, like the same way if you have losses on your portfolio, um, you can kind of use that to offset income elsewhere. Uh, and I don't know the exact rules on this for on the personal side, but you can carry forward some percentage of those losses, right? But again, like in some cases, this is going to be a really important aspect of what drives performance. In the case of Spotify, it's like not really that big of a deal. What really matters in the case of Spotify is like how many premium subscribers are they going to have? What's the revenue per user going to be? What's the gross margin going to be? How many ad supported users are they going to have? What's the revenue per user going to be? What's the gross margin going to be? What percentage of revenue? I mean, this is kind of like a lesser thing, and whatever. Just assume they'll always spend like 10% of revenue on research and development, and then you have to make a determination on like what the customer acquisition cost will be, and then like I think 5% is kind of generally like a good number for G&A, so maybe that kind of just stays there as they grow, to kind of deploy more and more people into like all the different countries that they operate in. But like the amount of like tax loss carry forwards that Spotify has, that's not really going to be moving the needle in terms of like, is this like a 5x in 10 years, a 10x in 10 years, or a 2x in 10 years, right? So, or a 0x in 10 years, right? But if I was looking at like a distressed company that where the tax loss carry forward is like a pretty significant part of what's going to drive my returns as an investor, yeah, like I'm going to spend more time on this portion. But for now, like we're just going to ignore that and just run it like this. Okay, so this is kind of how I would break it up for Spotify. Feels like this is a pattern in all the videos, me running over. So sorry about that, but I hope this stuff is helpful to you. But like, we can just kind of sit back and like admire the cleanliness of this, right? And just think about like what we've accomplished here, which is like breaking up like this chaos of numbers. And by the way, like this isn't even the real chaos. This is like 6 pages. Like if we actually crack open this Spotify, for foreign issuers, it's a 20F instead of a 10K, but it's like a tiny detail that doesn't really matter. I mean, like look at how tiny that cursor is. Like this is the long annual report. There's a lot of information here that does not matter, right? Key of investing is not reading 100 pages a day. It's knowing that like the 20 pages that matter, right? And so I've kind of done that job for you, like kind of picking that out. But like once you kind of have practice building like these, let's call them like funnels, or like a walk from revenue to, oh, I guess we didn't do the diluted EPS, so let's just quickly do that. Diluted shares outstanding. Like once you know how to do this, like once you know what this looks like, what matters, what to focus on, then like you're just gonna like crack open one of these filings and you're gonna like zip through this like a champion, because you're gonna know what to focus on, like what matters, right? Like you're gonna be in here, like this doesn't matter. Like Thomas Staggs is a member of our board of directors. He's been a member of our board of directors since June 13, 2017. Like I don't give a fuck about this, like, right? Like I care about this. So I'm just gonna do like command find and figure out like the key pieces of information I need. And then I'm only going to do research in like the things that matter, the things that I care about, like kind of honing in on like these key assumptions, right? And I'm not going to get lost in this detail about like the board members and like where they went to college. And I'll do a separate video on like some of the other parts of an annual report, like the risks and stuff like that. Because there is a section where they describe the risks, and like it is useful to kind of skim through that. But yeah, like I just want to kind of like take a quick pause and kind of talk about like why we're doing things, like what's the use case, how useful is it, what we're doing, just so we're not like blind. Because I remember like when I was learning this stuff, like there's a lot of like rote memorization and like blindly doing things, and that's like blindly memorizing definitions and just doing monotonous tasks is what kills learning and critical thinking, right? So generally, I want to make sure we avoid that, because honestly, investing is like you can make it simple, like and do the middle school math. Um, but yeah, what was I gonna say? But it is like a fairly engaging, like intellectual puzzle that you're solving, right? So I know I said it's like fifth grade math and like, whatever, like middle school math and like sorry, not fifth grade math, like explaining stuff to a fifth grader, doing middle school math and a little bit of research. And that's true. But it is like, I don't know what the right comparison would be, like chess or, a Sudoku puzzle or something. But like it is like intellectually engaging to like have to think about this because ultimately, as an investor, what you're doing is you're trying to predict what the future will look like, right? And you don't know what the future will look like. There's uncertainty, and so you have to make your best guess. Um, and you'll realize very quickly whether this you want to play this game or not, and whether you want to just buy the index and call it a day. But I just want to kind of show you what it takes to do like a decent analysis into a company. So diluted weighted average ordinary shares. Okay, 187.583, 193.943, 195.846, 195.846. So another thing I want to note, some companies might have like multiple classes of shares. And so always, it's usually I'm pretty sure it's always, but don't quote me on that. And this might actually be an example where it's not. It's usually in the first page here. Here we go. Right. They'll tell you the number of shares. Because sometimes on Google and like Yahoo Finance, the share count can be wrong. And that'll just lead to like all of these numbers being wrong. So just kind of crack open the filing and just on the first page, just make sure like it's like roughly in the same, like, 193.293 versus like 195. Like that's not going to matter. Like no one cares about it. It doesn't matter. It doesn't move the needle. But 193, okay. And I don't see any other like class of shares that are being listed here. So this seems like a relatively safe number to run with. So this is a diluted EPS. All right. I'm just thinking whether I should do a discussion on like what happened and why they're, I have a theory why this happened. Stock, paste, compensation. Just trying to see like what happened, and we're already at 48 minutes. Maybe we save that for another. Okay, so gross profit, kind of that segment. Okay, so the sales and marketing increased quite a lot, right? That's what kind of drove this increase in costs, which then drove a massive decrease in the operating income, right? Like because we can just kind of see like how much should gross profit increase. I mean, this ad supported thing barely even matters right now. So this thing went up by 422, but then R&D went up by 475. This went up by 437. So like they aggressively reinvested in their business. I wonder what, let's see, the cash flow statement. Scrolling through here to find the cash flow statement. I know that's not something we've covered, but there we go, financial statements. Okay. Huh. Yeah. So it wasn't because of stock-based comp going up. Yeah, we'll save this one for like the and for the next few modules in terms of like what caused the operating income to tank, and whether it's a short-term issue or a uh, a long-term issue. But for now, this is kind of like how Spotify makes money. This is the walk from revenue to EPS. So as always, post your questions, comments below, random thoughts, anything, and let's keep going. I'll see you in the next one.